pleasure to be with you right here on the India Development Debate on ET Now. I'm Supriya Srinath and along with me is my colleague and co-anchor Sandeep Gurumurthy. Let's take this straight across to the big debate tonight then, because banks in India are as safe as ever and the government will ensure complete protection of depositors and investors alike. That's the word coming in from Finance Minister Arun Jaitley, who today tweeted to arrest rumours over the proposed FRDI bill. The Finance Minister's clarification comes after rumours over a bail-in provision which could make bank deposits unsafe. Jaitley says the FRDI bill contains no such clause that will adversely affect depositors.
Jaitley, we have cleared the air for now, but there are some big questions. Was there an intent at all to make the depositors bailout failed public sector banks? Is there an agenda to alter the relationship between the depositor and the bank? Who takes responsibility for what appears to be a clumsily drafted bill? Banking on trust. That's the big debate tonight on ET Now, the India Development Debate. Joining us on the show this evening, we've got Mr. H.R. Khan, former Deputy Governor of the RBI, Professor Meera Nangia of the Delhi University. We've got Anand Narayan, market expert, Mandar Kagade, public policy consultant in the financial sector space, and Maithili Bustur, consulting editor of ET Now. Thank you so much, all of you, for joining us in what promises to be a riveting debate. I'm going to start off with you, Professor Nangia, because it was your column in a paper almost a month ago that sort of brought the spotlight on the FRDI bill. For the benefit of some of our viewers who sort of have little information on the subject, could you simply explain to us what the brouhaha is all about?
There is this new bill which has been passed by the cabinet, and it is going to go to the parliament. And what it is looking at is, it is looking at resolution of financial institutions. Like we have last year had this insolvency code, which is looking at insolvency of companies, of corporates. Similarly, we are having this, like in case a financial institution like a bank or an insurance company becomes sort of near insolvent or is insolvent, then how do we liquidate that particular company? Banks in India are in the corporate form, and public sector banks, the government has the majority stake in those banks. And so this bill is looking at that situation, and it's actually coming from the Financial Stability Board. Now, this was an institution which was set up after the 2008 financial crisis in America, the banking crisis. And after that, this bail-in clause is an important integral part of it, where it says that if a bank becomes bankrupt, then either that bank is not so bad that they need to shut it down, so they'll do a certain kind of a bail-in provision, and in case the bank is too far gone, then it is going to be merged, or the assets, the good assets will go to a bridge institution. So there are formats of how the bail-in will work, but the crux is that in case the bank is making a loss, then it will be recapitalized using the deposits of the customer.
Okay.
So my money, if I have, X rupees in the bank, it will be used to recapitalize the losses, and I will get less than what I actually have deposited in the bank.
No, if my money is going to be less than what I have deposited, that's room for panic. But Maithili, I'll quickly allude to just that point. Does this clause fundamentally change the relationship between a depositor, between a customer and the bank that has been held for so long? And on that ground, is the panic justified?
Well, the way the clause is, this is section 52 of the bill, it does leave it open to that interpretation. So it is likely to spread a lot of panic amongst the depositors in India, because remember, unlike banks abroad, here the banks get their deposits from retail depositors. Banks abroad get it primarily from the wholesale market, from like institutions like money market, mutual funds, etc. So even though such a provision is there in some of the laws abroad after the financial crisis, as Dr. Anange mentioned, the fact is that when we have a similar provision here, it is like comparing apples and oranges, because here the bulk of the deposits are retail deposits, not from wholesale depositors. And it seems very strange to have a parallel with the IBC. There you are having the IBC to protect the creditors of companies, and here you are trying to do exactly the opposite, because bank depositors are essentially creditors to banks. Remember also that we have essentially public sector banks. They are much more tightly regulated. So the mere existence of such a clause, which could lay it open to misuse, I think is very dangerous, and the government must scrap this clause.
That's a strong view coming in from Maitri. Now, again, my sense is a lot of, a lot of viewers are tuning into the show with little understanding of the bill. So I appeal to the panel to keep it as simple as possible, because we want, we don't want to spread panic. We want viewers to get a clearer idea of what's really going on. How is this going to impact their deposits, if at all? Mr. Khan, firstly, sort of very basic question, which is a lot of viewers would want to know what happens now, as of today, before this, let's forget about this bill that's under the consideration of the Parliament. As of today, if I have deposits in a certain PSU bank, and if that bank were to go bust, right? What happens to my deposits as of today? As per the current set of rules and regulations, what happens to deposits in a PSU bank of an investor, of a depositor that's gone bust?
So first of all, let me tell you, last so many decades, neither government nor RBI has allowed any banks list of public sector banks to fail. Either we have seen merger, amalgamation and all that. So in the Indian context, it's a theoretical construct rather than practical issue, but nevertheless we must have a framework for the worst case eventuality. Right now up to 1 lakh deposit is insured by Deposit Insurance Corporation, and if you see the total, around more than 81-82% of the depositors are insured, and if you take the total value, 31 to 32% value is insured, if the global threshold is around 25 to 30%. So that way we have a good insurance framework. Of course, there has been talk that given the inflation and all that, if you compare with other countries, this 1 lakh looks less. Possibly that is a separate issue which is perhaps being considered. So as things stand now, up to 1 lakh deposit in the same name, it is insured. Beyond that, in a theoretical possibility, if there is a liquidation of the bank, there is no clarity about hierarchy of things. So what this bill wants to seek is provide a clarity about what will be the hierarchy in terms of distribution of assets when there is a liquidation situation. And the proposed bill protects whatever is insured, and
right.
The insured amount is protected in the proposed bill, and right now it is 1 lakh, tomorrow it may be 2.
Okay, tomorrow it may be 2 lakhs is the word that's coming in from former Deputy Governor of the RBI, Mr. H.R. Khan. But right now, the provision and the statute on the, on the statute, it is 1 lakh which is insured. Anant Narayanan, let me ask you, the deposit insurance that has been referred to, that has been spoken about as far as that insured sum is concerned, is that largely irrelevant? Because like Mr. Khan and like Maitli and everybody else has pointed out, banks in India have so far not failed. I mean, both the RBI and the government get in very proactively. If at all there is a sense of a fledgling, failing bank, it's merged with a stronger bank to ring fence the customers. So in some sense, that whole deposit insurance clause, which is there in the existing statutes, existing law itself, is extremely irrelevant, is it not?
Absolutely, Supriya. Just to step back a second. We've got to understand why all this brouhaha is happening right now. And as the good doctor mentioned right in the beginning, this is because after the crisis, Western banks were in such horrible shape. And then you had this too big to fail argument, and the fact that the Fed had to pump in money through the TARP, and everybody was at their tenterhooks on whether the banks would survive or not. So they all had this huge headache, and they decided that they're going to come together. So the Financial Services Board came together under Bank of International Settlements, complicated name, let's just call them Basel. So Basel got together, took together the G20 countries and said, listen, we've got to put in, checks and balances in place so we don't have this too big to fail construct again. that we don't have taxpayers' money being required to bail out banks, and let's make the banking system as safe as possible. So effectively, the entire construct was, let's give the banks loads of capital, loads of liquidity, and then on top of that, make sure that we still don't require taxpayer money to bail them out, because we'll use depositor money instead. This was the global construct. Now, effectively what's happening is, because the Western banks had this massive headache, we are now asking State Bank of India to put loads of ointment on its head, right? Unfortunately, that's the way in which the world works. Now, I have a big problem with the way capital and liquidity, strictures are coming down from Basel. This one, frankly, is not that bad. It does give clarity, as Mr. Khan also mentioned. It gives some kind of clarity in a situation there was no clarity earlier. Now, the wording, of course, is bad. And I agree that we've got to, instead of doing a copy-paste of those regulations from the global constructs, we've got to incorporate the specific situations that we have in India. Here in India, we are asking people to go, retail people to go and open bank accounts, Jan Dhan Yojana, financial inclusion. On the side of that, if you say, by the way, I might take away your money in case the bank that you happen to place a deposit with lends money to a person who runs away, then I might have to take your money. That's a completely wrong message to give. And that's not the intent at all.
Sure.
That's the part that we've got to clarify, and we've got to kind of make it specific to the case of our country to ensure the people that that's not going to happen. We are here to save the banks. We are here to protect the banks. As Mr. Khan said, it has never happened in the past, and it won't happen in the future.
Okay.
That language has to come through in the bill, which unfortunately doesn't currently.
Okay, so you're saying there's a problem in the language, but fundamentally this is going to clear the air. It's going to sort of clear the air and bring some clarity on this issue. Maithili, of course, has a different point of view, but let's take it to Mandar Kagade, public policy consultant as well, and he is in favor of this bill, and he believes it's going to protect the interests of the depositors. Mandar, before I get to that point, I again, sort of stepping back and sort of trying to understand the logic here and the context of this move. Now, this comes just weeks after the IBC ordinance has been amended. Now, in the case of IBC, the provisions have been made more stringent to safeguard the interest of creditors. Doesn't this act in contrast? Why are depositors being put at higher risk? I mean, equity holders logically should be at a higher risk, and they should get the downside if a bank fails. Why are depositors being put at higher risk? And it sort of logically seems to be in contrast with the intent of, say, the IBC ordinance. Mandar.
Right. So right at the outset, I beg to differ with the panelists that believe that the bail-in provisions put depositor money at risk. I think a bare reading of the whole bill lends credence to the contrary argument. In fact, let me just briefly sketch out the reason why, the way in which bail-in works is that you have institutional debt that lies, in the mezzanine layer of the capital structure, and the bail-in provisions are essentially written as a covenant in the deed, and they are written off. They essentially taking the first loss in the case the specified service provider reaches a critically undercapitalized position. The bill largely follows that global position, and as such does not in fact put depositor money at risk. To further sort of underline this argument, one merely has to look at section 53, which specifies what a bail-in instrument does. And a bail-in instrument, it secularly refers to what a bail-in instrument might do in the context of what you call securities, right? And that is consistent. A security is not a deposit. A security is essentially, say additional tier 1 bond, for instance. And those securities would be written off contingent on the bank or a financial institution reaching critically undercapitalized position in order to shore up the capital, essentially enabling it, facilitating its its solvency. And this happens not at a critically before it reaches sort of the ultimate point of termination.
Right.
If you construe 52 and 53, there is no reason to believe that depositors' money is at risk.
Okay.
Right. I'll just take it across to Professor Nangia. And Professor Nangia, Mandar here believes that depositors are better off, and this bail-in provision, if looked at through the entire legislation, doesn't really mean that the money will be taken away from the depositor and put to recapitalization of public sector banks, and you're going to get less than what you had deposited. How are you going to counter that argument? Professor Nangia?
You know what, I am not, I've not really understood what, the panelist, I'm sorry I didn't get her name, what she is talking about, because the bail-in provision is very clear that the depositor is, the deposit of the customer is going to be exchanged. In exchange of that deposit, the customer is going to be given equity shares. Right, that is where it is coming from. And this is like, initially you had said it's a clumsily drafted bill. It's not a clumsily drafted bill. This bill is following the exact sequence which has been laid out by the Financial Stability Board. And if you go to the Financial Stability Board website, you will find that, as close as 30th November, they have brought out a paper on how bail-in is actually to be implemented. So they are working on it, at a war footing, and we are adopting all those things. And if you just go to the Finance Ministry website and you look at the draft committee which was set up earlier, and then the bill, draft bill was made, so you will find that whatever are the, sections which are used in the Financial Stability Board website, the same things we are following, just the way it is. There is no change in that sense. And the second point that I want to make is that, the bill is looking at resolution of financial institutions. Their concern is that how to save a bank, right, how to save a financial institution which is providing a financial service.
Right.
Their concern is not how to save the depositors' money.
Okay.
So if I am wanting to save a company, then what will I save? I want to save their equity, I want to save their capital so that they can continue to be in business. Okay. So that is where the focus is different, and of course the customer's money is going to be used in bail-in.
Sure.
There is no doubt about it.
Okay.
Whosoever says that it is not going to happen, it is going to happen.
Okay, fair.
And my other argument is that, when we talk of...
Professor Nangia, if I could just interrupt you, I'll come to you on that other argument. Let me get a quick word from Mr. H.R. Khan, former Deputy Governor of the RBI, and eminently qualified to comment on this particular point. And this is, we've got two very divergent views coming in on the debate on the bail-in clause. We've got, Mandar, who believes that it's actually going to protect the interest of the depositor, which is in complete contrast to what the general view out there is. And there is a fair amount of panic, a lot of panic, in fact, in social media. So Mr. H.R. Khan, we want to hear from you, your own assessment of what the bail-in clause does when it comes to the deposits. Does it protect the interest, the bail-in clause in its current form in the FRDI bill? Does it protect the interests of depositors, or do you believe that it actually damages the interest of depositors?
No, let us take an example. In a current situation, if there is a bank and there is erosion of net worth, whether say for example, in many cases we have seen cooperative banks, some of the cooperative banks going down, and we find beyond 1 lakh people lose money. So if there is an erosion of net worth, it happens. So it's a fact of life right now. But fact remains, no commercial bank has gone down last so many years, so many decades. So that is point number one. Point number two, this has to be seen along with what is the regulation and supervisory framework in India, whether they are robust enough to see the prevention is better than cure. So I believe we are working on those areas where the regulation becomes strong, the supervision becomes stringent, so that this situation does not arise. This is a situation where you are from ICU, you are moving to a morgue. So we do not want that situation to come. So we have to see the robustness of our regulatory and supervisory framework, I believe, which are robust and they are improving. For example, recent steps for prompt corrective action. The third point I would like to say, having said that, possibly there is a case at looking at the hierarchy of uninsured deposits, what has been provided in terms of first the reimbursement to the corporation, second is the workman staff, resolution cost, and the people who get priority over depositors are the collateralized creditors to the bank. Possibly we can relook at that particular provision in the interest of uninsured deposits. But government dues come below uninsured deposits. So, that is a positive. But the secured creditors coming ahead of uninsured deposits, possibly that can be looked at.
Maitri, I know you fundamentally disagree with that view. You don't really believe that the bail-in clause actually protects the existing depositors. You believe it works against them, it's adverse, right?
Yes, because it's a very ambiguously worded clause. So, it could be used against the interests of depositors. And if we are so keen on protecting the interests of depositors, the way to go about it is to increase the deposit insurance amount. This 1 lakh amount was fixed in 1993. Just imagine, so many years ago, almost immediately after the reform process had just begun. So, if we are really serious and sincere about protecting the interests of the depositors, just raise that number, because the US has raised it from $1 lakh to $250,000, $250,000. So, if the US can do that, why are we still stuck on that 1 lakh crore? So, if you're really bothered, we should increase it, number one. Number two, as Harun said, yes, we've never really had a bank failure. The Reserve Bank, and I've been a frequent critic of the Reserve Bank on its monetary policy management, has been remarkably agile when it comes to protecting banks. They have managed mergers, they have managed takeovers, and so far not a single bank has gone down. A couple of cooperative banks have closed, but not a single commercial bank. So, I think we're trying, why, if it ain't broke, why fix it? Why lend ourselves open to a situation where there could be misuse, where there is fear amongst depositors? Because remember, it is these bank deposits that provide the savings for banks to lend. And if the people withdraw their money from banks out of fear, what will happen to the investment? As it is, we are finding the investment in the country is coming down. So, I think this is a very dangerous route to go, and I think the government should make it very clear that they are going to drop this clause wholesale.
Anand, comment on that. Maitli says if it ain't broke, why fix it? You believe it's going to bring some clarity, and obviously it's been tried out in several developed countries, UK being the latest example with varying degrees of success. But, like Maitli said, in the case of US as well, the deposit insurance amount has been raised substantially. We're still stuck at 1 lakh rupees, which appears to be, extremely inadequate. So, comment on that, and also, do you believe that, is there a necessary need to follow the Western template for a developing country like India?
So, can I just put some clarity around this, the way I understand it at least? Okay.
Sure.
First things first, this does not make depositors more risky or equally risky as equity holders or, bond holders or tier 1 bond holders. The hierarchy still remains the same, which means if the bank has a loss, it will be first equity holders, followed by debenture holders, followed by people who've put in money in the form of total loss absorption capacity bonds, and so on and so forth. So the hierarchy doesn't change. It's not as if the depositor is the first port of call. Now, if all of the net worth has got eroded, that's when the resolution corporation has the option of calling for a freeze on the deposits or converting a part of the deposits into equity. That's the theoretical construct. By the way, this no way comes in the way of the government standing up and saying, let's not do that, I will bail the bank out as well. That doesn't stop just because you have a resolution framework doesn't mean we are bound to it. The government can always step in, or the resolution authority can step in and say, you know what, I won't follow this particular process of giving equity to the deposit holders. I will follow a separate route and do an amalgamation instead, right? So in that sense, it doesn't really change things from what it was earlier, except it tries to put a framework where one option is kind of defined properly. Last bit, I completely agree with you, Sandeep. We should not be doing a copy paste of the West. And the professor is right. It's not poorly worded. It's purely copied and pasted from the way it's done globally. But the reality is, as Mr. Khan was mentioning, our construct and our context is different. We have, a lot of small investors and depositors who are not financially literate. The last thing you want for them to go through is an unnecessary risk, especially at a time when you're doing, expansion of financial inclusion. So you absolutely have to increase the size of the deposit insurance. And additionally, as Mr. Khan rightly said, there has to be a hierarchy where the small depositor is given ultimate protection over other creditors. In fact, in the UK, that's the case. You have something called I think it's called the normal businesses or the normal deposits. where actual small retail actually gets bigger priority than corporate deposits or other unsecured creditors.
Okay, Mr. Mandar, I'll come to you on the point that has been made in this debate, and particularly the one that Anandaran just answered, which is about we can't copy paste what is done in the West. And in the West, this perhaps could be done because bulk of the deposits in the West are also wholesale deposits. Here you've got bulk of the deposits which are retail deposits. You know, money, petty little cash that people like you and me and everybody else puts in banks with the assurance that it's the safest there. And if you actually, I don't have the numbers handy right now, but I think a large part of the deposits is also money which is under 1 lakh in every account. Given those numbers and given that reality, can a developing country like India ill afford something like this?
See, I think you know, if bank failures are bank failures, and market discipline, capital adequacy, bank solvency, all these issues, you know, transcend. They're sort of, you know, transcend jurisdictions, developing, divide, and so on and so forth. I think you know, I sort of, just to sort of reiterate and go back, my view of the bill, you know, pans out from a composite reading of the bill. Clauses 52 and 53 clearly indicate that the bail-in applies. So to the extent there are securities on the liability side, securities and deposit securities are in the nature of bonds. So you know, bonds which are held by institutional capital, which charge the bank or the financial institution concerned appropriate coupon against that risk. So and to the extent that's smart money, they have the risk appetite and the knowledge to take that risk on the bank concerned or the financial institution concerned. Deposits aren't at risk. To the extent the other part of the question is concerned, I think you know, there may be a case for raising the barrier, the 100,000 limit that we currently have, and the bill adequately accounts for it, because it mandates, it rather empowers the corporation to consult with the appropriate regulator and the central government to raise the you know, threshold that we currently have. It could be 200,000, it could be 300,000. I think a good empirical way of finding out is what the median outstanding bank account balance is on a quarterly basis. But there could be other metrics, and we could, you know, arrive at that number based on, you know, good empirical evidence. So, you know, to go back to and to sort of summarize my response to your question, bank solvency and bank capital adequacy are transcendental issues, and market discipline also, because you don't want taxpayers to be on the hook for, you know, for the bank. We recently had a 2 trillion worth of capitalization, right? So we don't need to be on the hook. We need to be careful that we don't sort of have this situation again. I think in that sense, this bill is a very useful step forward. Thank you.
It's wonderful that we've got all sort of, you know, corners covered, you know, all spectrum of opinion in this debate, so that the viewer gets a full picture of what's really going on with the FRDI bill. But Mr. Khan, if I may come to you, because two of our panelists have made the point about the need, in fact three, to increase this deposit insurance amount. 1 lakh appears to be inadequate. Do you think the time has come for the government and the central bank to relook at the deposit insurance amount?
As I said, if you take global threshold, our situation is not that bad, because we are covering almost 32% of value of deposits. But in Indian context, we don't have social security. People use bank deposit as their social security. I think there, and as Maithili was telling, it has not been, it has remained so for last 25-30 years. There is possibly a case to increase it. But then there is a situation that people will be distributing their deposit. So 1 lakh, 2 lakh here, 2 lakh there, multiple places. Now that we have Aadhaar seeding, so one particular Aadhaar seeded account, you can say that not more than 2 lakhs or 2.5 lakhs. With Aadhaar seeding, that multiple bank accounts, people getting multiple benefit will not arise. So with Aadhaar safeguard available, I think we could possibly increase it to 2 lakhs. That is one way of doing it, or maybe to 2.5 lakhs or 1.5 lakhs. Some formula can be worked out. The other option could be with Aadhaar based people who have got say up to 2 lakhs and 2.5 lakhs, beyond insurance they get a priority claim in the hierarchy of distribution, because now we have a Aadhaar linked thing. So, people cannot distribute the deposit. So, we can have two solutions. One is increase straightway linked with Aadhaar, other is beyond 1 lakh or 2 lakh, some another 1 lakh you can give them a hierarchy if it is Aadhaar seeded account.
That's a valid point indeed. With multiple accounts, how do you keep track of what are you giving them the deposit insurance for? But Maitli, I'll come to you, and on the larger point of the regulator and the whole issue. I mean, right now, and you had pointed out earlier in your answer, and just to reiterate that point, the RBI preempts a bank fledgling or failing and falling, and with an idea to ring fence the depositor, the RBI and the government together. And there are numerous instances of how they've gotten together, you know, saved that bank, merged it with a stronger bank, and the depositor's money has been assured. The depositor has never seen money go down the drain. But under the new FRDI bill, the Resolution Corporation takes over the mantle of what RBI has done so far as you know, the deposit insurance and all of that is concerned. I just fail to understand what's the whole point of having a resolution corporation when you do have the RBI, which is the banking regulator, do that job with a far bigger ambit, with a far bigger mandate.
Absolutely, Supriya. It defies all logic, and the only logic can be, as Dr. Nangia has said, that because we blindly ape the West in whatever we do, because the fact is that whatever we may criticize about the Reserve Bank of India, their regulation and supervision of banks has been far superior to that of regulators abroad. The track record of the US in terms of bank regulation has been appalling. The fact is that no public sector bank, no large private sector bank has also failed in India, and this goes to the credit of the Reserve Bank of India. In fact, I think, why are we creating a situation, we are dealing with a purely theoretical kind of situation, possible situation, which might spread fear. Agreed, as Mandar said, possibly we are talking only about bonds, we are not talking about deposits. In that case, why doesn't the bill make it explicitly clear that this does not cover deposits at all? That would solve the problem completely. Even if you do want to have some kind of a hierarchy or waterfall, and you want to have a law which covers, you know, addresses the issue of insolvent financial institutions, given that such a situation has never arisen even in the past, then if we want to make it very clear and quell all fears, then insert an additional clause saying that this does not in any way cover any deposits by the bank, by customers. That would solve the problem. So, as I said, even if you want to blindly copy the West, there are ways of adapting it to our situation. And in the process, by not doing that, we are unnecessarily spreading fear. And as Anant mentioned, at a time when you are telling people, please come to the bank, put your savings in the bank, we are doing exactly the opposite, where you do something with the right hand and the left hand takes it away. So, I think this is a very wrong way of going, and getting the resolution corporation, which has absolutely no idea about the bank, it just defies all logic. The Reserve Bank is the authority, it is the supervisor, it is the regulator of banks, and knows far better. And let me just conclude with one just final comment. Every inspection of the Reserve Bank of India, and in fact Reserve Bank of India is one of the few central banks which does an on-site inspection of the banks, and every inspection report concludes with the sentence, the bank is in a position to pay all its depositors in full. So, the entire inspection is with that purpose in mind, and so you really don't have to worry at all. And I think this bill is completely spreading the wrong ideas amongst people, creating fear, and completely unnecessarily.
I have to take it to Mr. Khan to get his view on this point that Supriya asked Maithili. You know, Mr. Khan, RBI as a regulator has intervened whenever a bank was on the verge of failure by protecting the interests of the depositors and consumers. But under the FRDI bill, the Resolution Corporation in some sense takes over the mantle from the role. Do you agree with Maithili's criticism on the need for a Resolution Corporation, and does that sort of in a sense take over the power of the banking regulator step in such a situation?
No, I understand there are issues relating to what could be the shape of resolution corporation, what could be the relationship with the regulators. Sectoral regulators obviously have much better knowledge of the entities they are regulating, and they have been doing day in and day out. This is a new institution. What is being tried out is in the resolution situation, when things go to critical stage, possibly you need a specialized organization, because they also become receiver, sort of a liquidator. So, they will handle a situation where it goes beyond control. what we are talking about, possibly public sector banks or commercial banks may not fail, but other types of banks may fail. You get new players, you have payment banks, you small finance banks, and the way the public sector banks are losing the market share, there may be more of market share to the private sector banks, more banks may come into play. So, in future the situation may be slightly different than what we are seeing today. And I agree that performance of regulator and supervisor has been good, but past is no indication that future is going to be equally good or better than what has happened in the past. So, this is only an contingency arrangement. In that contingency there should be a specialized organization. Then also please remember, regulator has a bias to see that we don't call it that it is going to fail. So, sometimes that bias also is there. So, there is a specialized organization, but at least at the initial stage there is need for a lot of coordination between the proposed new entity and the existing regulators, and the turf war should be avoided to the extent possible, and till situation becomes really bad, the regulation corporation should not step in.
Professor Nangia, we touched upon it briefly before we took a break, and you made this point on because there is a view coming in that a lot of it has to do with what is a clumsily drafted law and not necessarily the intent. But do you believe that the intent itself is what is a little questionable? Because even the government today in the finance ministry is saying that while it's there, the clause is there, but it will never be used in a country like India. So some may argue, why keep it if it's never going to be used?
What I feel that if we are so sure that we are not going to use it, then why do we need such a clause? If this new law is going to be the same as the existing law, then why do we need the new one? So obviously there is something in the new law that is going to do something that is different from how it has been till now. And there are 2-3 quick points that I want to make which will clarify the picture. Like when we deposit money in the bank, as customers, we don't think that we are creditors of the bank, that we are giving this money, we are not taking any security from the bank, and whenever I want my money back, the bank will give it back to me. So, but if you look at it from the accounting point of view, then I am an unsecured creditor because the bank has to owe me back money and I haven't taken any security from the bank. So, the issue happens only when we are saying now if the bank is financially not sound and it needs to be liquidated. Then if it needs to undergo, or it is not going to be liquidated, it's going to be recapitalized, then what is going to be my status? So, of course, there is a waterfall clause and of course, equity shareholders will take the hit. There is no doubt about that. But if we are looking at we are seeing the corporate insolvency, it's the secured creditor who gets the first right to the assets. And in a failing bank, the assets are fewer and the liabilities are huge. So, the uninsured part of the deposit is definitely not going to be coming back because the bank has no assets to give. Like now we are saying for these corporate borrowers, how do we take money from them? They don't have those assets to give us the money unless the bank recalls the loan, invokes the personal guarantees and so on and so forth. And of course, Maithili has been very kind to the Reserve Bank. I have a different opinion at the moment in terms of how the IBC is going. And the second thing is that once the law is in place, the argument that is being offered that, the government can always take over. There's nothing which says government can't act. Of course, the government can always take over. The government is the absolute power in any nation. But once a law is in place, you tell me how many times we are told, let the law take its course. So, if the law exists, things will happen as per the law. And if the law says that this bank is becoming insolvent, so there must be this bail-in clause. We may take the consent of the customer. So then what are we saying? We are discouraging the customer. We are saying, we are changing the relationship between the customer and the bank. That now I have to decide, I don't invest in the stock market because I think it's not safe. So I have to think, do I want to put my money in the bank? And I have to be aware that the bank may make losses and I may not get my money back.
No,
so it is changing the relationship.
Right.
I may invest my money somewhere else.
Actually, that's a very valid
we
point
can't
that you're making,
treat
because
if I'm dealing with a company, supposing I'm a supplier.
Right. No, I'll just come back to that, ma'am. But I think that's a very, very valid point that you're making, that the power of the choice, and I think a lot of India does that, right? We all believe that banks is the safest instruments, and at least, you know, at least our parents and salaried class and retired professionals, they all believe banks is the safest instrument. Your money will never go down the drain there. Mandar, I wanted to come in on that point. Is this extinguishing a choice that people have made for so long? And also the point that she made in a larger context, that this is a uninsured deposit. There is no collateral against this. There is no security that the bank has given. So for all practical purposes, forget about the money if this clause were to come into effect, if this clause were to come to statute. And if at all the finance minister believes that having a clause is good, we're not going to use it, why have the clause at all? Why create panic? Why put fear in the minds of people?
So just to be sure, you're talking about the bail-in clause here, right?
That's right.
Yeah. So you know, two things. One, so far as the technicality of unsecured unsecured creditor relationship with the bank, that is completely well taken. It is an unsecured creditor. However, that is why deposit insurance exists, right? Deposit insurance exists, and its rationale traces back to the 1933 FDIC Act in the US to avoid precisely the kind of situation that Professor Nagia worries about. And that is why, even though it's not secured with collateral, we have deposit insurance to the extent that the corporation will notify under the current bill. And to that extent, the deposits would be in fact secured. As to whether this clause, the bail-in clause, is necessary, like my interpretation of the bill, which is to reiterate again, clause 52 read with clause 53. The bail-in clause applies only so far as institutional debt is concerned, institutional liabilities are concerned, and because this is smart money, this money can take risks. The risk is adequately accounted for in the coupon, and at a critical capital stage of the bank or financial institution concerned, this will trigger so as to capitalize it to and shore up the tier 1 capital of the bank. I think it's well reasoned out as to why this clause has to be there.
Okay,
and,
okay. Mandar, I'm just going to interrupt you. I want to get in a quick word from my panelists, closing comments really there. And Mr. Khan, if I may come to you, given this whole furor that this move is created, that this bill is created, it's become a political issue as well, with some political parties raising as well. What's your own sense? Do you think the final bill is likely to be significantly watered down? Will they drop the bail-in clause at all? What's your assessment of what's likely to happen?
I don't know what will finally, because the committee probably has not given its report, and I think some of these issues have been agitated before the committee, if I understand, and they will possibly give some recommendation on that. But as I was telling, the bail-in clause is not really something new, and in the current situation also, if there is an erosion of net worth, you suffer. The depositor, who to the extent he is not insured, he suffers. So it provides clarity. But what I was telling, possibly we could increase the amount, insurance amount, given that we have a Aadhaar seeding of accounts, so that protection cover increases. And there is also could be little more elaboration in terms of regulation when the bail-in clause is actually put in, that corporation has exhausted all other remedies, because they have to make a report to the central government why the bail-in clause is being brought into. So I think in the regulations perhaps they can put out little more detail when the bail-in is put into practice, and that should protect the depositors who are not insured to the extent they are getting exempted, they are getting affected by this bail-in clause.
Okay, Maithili, you watched political economy for far too long, and every decision has so much of politics embedded in there. Given the furore that this has created, given the panic that this has created, given some political parties are already beginning to make statements on that, do you realistically believe this is going to go through in its present form? I know the Joint Committee has to come back with its recommendations. They will eventually be tabled in Parliament. Do you believe this is perhaps going to be a more watered down version, taking care of all the concerns that have been raised?
I do hope so, but remember the government has a majority in the lower house of parliament, and though I think Dr. Rangia's view is a little alarmist, I think the entire issue could be resolved if you could add a clause specifically clarifying that retail deposits are not included. As Mandar said, this really basically relates section 52 and 53 that are the main clauses in contention. He says that refers only to institutional kind of deposits. So that clarity could be brought in, and that would immediately address all the fears, because remember, we do want people to deposit their money in the banks, and it is a fact that there is no other social security in the world. And if we want to have a similar law only because we want to tick the boxes and hence show that ease of doing business, we've jumped up a rank or two, because it's very important to tick the boxes also in today's world, and you also need to address the fears of people. So why not have that additional clause in the bill clearly specifying that this does not relate to retail deposits, and simultaneously increase the deposit insurance amount, which needs to be increased because it's much too old. It's 25-30 years old. So I think that would address the fears. I think this government must do before people take fear and there is a flight of deposits from banks which we can ill afford.
Yes, it is.
No, Ananta, let you have the last word on this debate then to settle this once and for all. And we've got again all spectrum of opinion coming through in this debate. But fundamentally, for our viewers watching this show tonight, is there any room for panic? Is there any need to panic at all?
No, there isn't any need to panic. But I do believe, as the law is worded today, it does include deposits as well. I don't agree that this was only for institutional investors. Both the Financial Stability Board recommendations as well as the clause that we have currently here includes depositors as well, and I agree with Professor on that particular count. Now, the reason why we are doing this, though, is not because we have or the government intends to take the money away from the depositors. It is meeting the commitments given under G20 to Financial Stability Board, and therefore it's a global commitment under financial stability. It's not an intent to try and scare depositors away. I think where we have to compromise and make a customize in our particular case, and I hope the parliamentary committee does that, is to ensure that small depositors here who need the protection, whom we are encouraging to come into the banking system, are given the protection. I do agree with Maithili and Mr. Khan. I think deposit insurance needs to go up, and I think the maybe even small depositors can be kept outside of the ambit of this particular bail-in clause.
Thank you so much for summing it up so beautifully, Anant. And a big thank you to all our panelists this evening, Professor Nangia, Mr. Khan, Mandar and Maithili, for putting it all in perspective. The intent clearly may not be to take away the money from depositors. That can be the intent of no government, nor is that the intent of this government. But surely the drafting of the bill is a little questionable, and hopefully we leave it to the wisdom of the parliamentary panel to ensure that it clears the air and settles the debate once and for all.
I think more than wisdom, it also has to do with political hierarchy. Can any government in India afford to do that? Can you afford to take away depositors' money to recapitalize banks? That will be a big political blow as far as the government is concerned. But yes, it is up to Parliament now to draft a legislation that assuages all concerns. Thank you very much for being with us on this edition of the India Development Debate. Up next is Top 10 at 10 with Tanya Bharadwaj.
Bye.